U.S. retail sales data for March are due this week, and they are expected to show an improvement from the disappointing data so far recorded this year. However, what about consumer sentiment? It is likely to remain muted with speculation that tariffs will cause price jumps in the United States. Let's get more from Chris Hodge, chief economist, US at Natixis. Chris, thanks very much for joining us. I guess we are in this kind of weird twilight period, aren't we, that people will be tempted to see any backward-looking economic data as stale because we don't know what effect the tariffs will have.
I think that's exactly right. We said we had wholesale prices and consumer prices from March come in softer than expected. CPI was negative in the headline reading, and the core was also very low and almost rounded to flat. This was the lowest core CPI that we've seen in 4 years. And wow. I think reinforces our view, which we think is shared by Fed leadership, that domestically generated inflation does remain on a pretty favorable path. And in a normal environment, the Fed would be preparing the ground to resume the process of normalization and bring down its policy rate. Of course, the fly in the ointment is the still very much unsettled trade policy in the U.S., and the Fed's going to have to make sure that longer run inflation expectations remain well anchored before they move again.
Yeah, it's tough for the Fed, isn't it? I'm trying to remember our own central banker, Tiff Macklem, has said, well, look, monetary policy is not a great tool in a tariff war because it's not really suited to that kind of inflation. I suppose Jay Powell faces the same kind of dilemma.
Yeah, absolutely. I think the Fed is inclined to look past a one-time price shock, but it's going to want to make sure that the longer run inflation expectations are still down. They're not going to be able to do that until they see the peak impact of tariff-related inflation, which we think is going to hit in Q3. This is going to put the Fed's dual mandate in a bit of a bind, and it's going to force it to determine which one it's going to prioritize. We do see a very slow erosion in the labor market, but we don't think it's going to be a collapse. So we do think that the Fed will be able to cut in September, but we think that the policy rate, the terminal rate for the cycle has moved down, given the persistent drag that tariffs are going to have on growth.
You have a chart for us that shows the performance of U.S. equities and then an inverse showing for the bond yield just before Trump's tariff reprieve for 90 days. And you reckon that in some ways America was looking like an emerging market during those fraught days?
A bit. You had correlations in these various asset classes move pretty close to one, which is not something that you typically see. And I think these financial markets are swinging wildly based on news about what Trump is going to do next. And this highlights two potential problems. First is this chaotic approach means that dramatic policy U-turns are not only credible, but they're to be expected, and they're based on the whims of one person. Second, it makes it impossible for businesses to plan and for consumers to have confidence. Supply chains are not easily rerouted. Mm-hmm. And CapEx takes considerable foresight and certainty about the future business environment. So even if we don't see the most extreme tariff policies enacted, they're still going to be higher than what we had before Liberation Day, and they are going to act as a drag on the economy overall.
Could we have 90 days, though, of to and fro and speculation? And will things even get resolved after 90 days?
It's a really terrific question, and we're really sort of in the worst of all policymaking worlds here, where you had these rolling threats of tariffs, and the private sector can't adjust to whatever operating environment that we're in. So I think the delay that we saw from last week and the 90-day carve-out that we saw on Friday does say that the administration's reaction function has shifted a bit, and the market turmoil has prompted a rethink. But given the focus on trade deficits and not trade barriers per se, countries with low tariffs are still going to need to find some concessions to indefinitely avoid the higher tariffs. We think the playbook is going to be similar to Trump's first administration, where the tensions with China were eased when China agreed to buy specific products from the U.S. Mm-hmm. And I think countries with low trade barriers right now will also be probably prompted into a similar arrangement where they agree to buy goods produced by U.S. exporters that are hurt by counter tariffs from China in this instance.
Is it likely that we will see significant inflation in the United States? I know you already touched on this, Chris, but will the tariffs that have not been withdrawn, and the disruption to supply chains, etc., is it likely to push up the CPI in the United States significantly?
Absolutely. And we think that's going to come in the next few months. We don't think that it's going to persistently push up inflation. We do think that domestically generated inflation is on a pretty encouraging trajectory overall. And combined with the drag on growth that tariffs are going to have, we don't think that we're going to see a persistent increase in price levels, but it will be a shock that we see over the next quarter or two.
And just finally, do you think that global investors are rethinking their stance towards the United States? I mean, for decades, it's been liquid. America's had low funding costs, partly because it was the reserve currency. Has there been a shift in attitudes? America is just seen as unpredictable now?
I think asset markets are telling you that right now, that there probably is a higher risk premium that has to be imposed on U.S. assets at this point. And I think that's a function of the fairly indiscriminate application of tariffs. They were applied to close trading partners like Mexico and Canada, and allies and adversaries alike. And when you don't have that sort of nuanced trade relationships, I think it forces everybody to reassess exposure to the U.S.
We better jump. Thank you very much indeed for joining us, Chris.
Thank you very much for having me.
Chris Hodge, Chief Economist, U.S. at Natixis. When we return,